Hello guys, in this video I'm going to be talking about trading. It's full-time trading course for beginners and it's all that you need to become a profitable and successful trader. I'm going to be talking about strategy, which strategy works, which strategy don't works, and all that you need to use. It's all trading patterns, trading technical things that you need to use to become a profitable, and what you shouldn't do, what mistakes you shouldn't do to avoid losing all your fucking money. So, here we go. So, all trading best, price action, smart money. Go. Introduction. What is trading? Trading is buying and selling assets, currency, stocks, cryptocurrency, raw materials, drug materials like gold, silver, oils, index, and a lot of other things. So maybe you understand it. In order to make money on price difference, based on market analysis and trading tries to predict price movement and find situation with a positive risk-reward ratio. It's a rare risk-reward. So we can have a 2 rare, 3 rare, 4 rare. It just means that, for example, you lose $10, but you can make $20. It's 2 rare. You can make $30. It's 3 rare. And you understand, you make 2 times more money, or 3 times more money, or 4 times more money. It doesn't mean a rare risk-reward. Trading. Trading is working with probabilities, analyzing data and risk management. It's professional activities that requires discipline, consistency, knowledge, and experience. And all time in all my video I'm talking about discipline, I'm talking about consistency, and all different things you can do, not only trading, consistency and discipline, and all time growing up. It's key to fucking success, bro. It's key to fucking success. I all time talking about that. And all my family, all my friends, and a lot of people which I talking about that. All people talking about that. But a lot of people, some people really don't understand it. I don't know. I don't know how it works. So, not suitable for people that really not suitable for these activities, for trading, for doing these activities. And I think trading is so hard. It's like a medicine, it's like a lawyer, to become a lawyer, to become a doctor, and it's so hard. It's really so hard. You must spend years and then you only can become a successful and profitable. So, really not suitable for who's are not ready to take a risk and work without guaranteed income. It's so much important because trading is not guaranteed income. Some months you can make money, some months you can't make money. You understand it? Mentally weak people who won't cope with physical psychology pressure, don't like nerve out. You have to spend a lot of time on graphing, analyzing, collecting data and statistics, testing hypotheses, keeping a journal, working with numbers. So if you don't like numbers, it's not for you. If you don't like statistics, calculating, analyzing, it's not for you. You must have a more math than, I don't know, about language maybe. Yeah, you understand it? Who is looking for a quick way to make money. Trading is not easy money. Trading is the easiest way, or is the hardest way to the easiest money. Remember it, please. Remember it and don't forget about that. Trading is the hardest way to the easiest money. Trading is not about easy money. Trading is hard money. And I have experienced more than 4 years, and I really can prove it because I know it. Because I really make a really long-term way, and I understand it. And only then I understand what I must use, and only then I become profitable. So after 4 years only, so what is trading? Oh, we do it. What is trading? What much capital do you need at the start? You shouldn't start with no investments at all. It really is true. Backtest, studying the technical base, the demo trading are all free of charge. When you already start a skill, you should use prop firms, which is the help of which you can to make a good profit without a large deposit. How long does it take to start earning? Everything is individual. On average, it takes from 6 to 12 months to understand about the mechanics, how to make a profitable strategy, as well as to develop a keen eye for the chart. However, profitable begins when the trader has also been able to adopt the right mental attitudes, eradicate destructive patterns of behavior, and discipline himself. So all time I'm telling a lot of people, discipline, discipline, discipline is the most important. And if you want to become a trader, you must have a discipline, all time doing sport every day, reading books, reading Bible every day, please. Pray God every day and do something every day that give you discipline, that give you consistency, and you must do it. If you want to be successful in something, you must have a discipline and consistency, because it's the most important thing in trading. Please, I remember it for you a lot of times in this video. Perspective for growth. Trading is one of the few areas when your income is not limited by the fixed salary like a common job or a career selling. You can start with a small amount of money and eventually reach the level when you can manage large capital and go to the Wall Street and make a lot of money and make millions of dollars. It was unbelievable. It was absolutely insane, I think. So if you can to achieve it, please tell me, please. If your strategy earns an average of 50% per annually per 1 year, and you can trade with $10 million, you can make it 50%, it's a $5 million per year in profits. It's unbelievable profit. Think about that. Really think about that. Trading, it's business. It's not like a hobby. It's not like something additional income. No. Trading, it's a business. And it's any business. A trader has a startup capital, money with which you enter the market, expected profitable potential income that you can make in trading, for example, 40% per year, or 50% or 60% per year, expenses, commissions, slaps, loans, props, software, subscriptions. Risk, profitable of drawdowns, break slows, physical breakdowns. So, understand it? Understand it. Continue. Realistic expectations. Change or you will not start making money in your first year of trading. It's normal. It's normal. It's really normal. You won't make hundreds of percent per month. From 3 to 10% is a good target, I think. So, of course, you can make money more, but we are talking about average performance over the distance with adequate risk management. Really good risk management. If you have a good risk management, you have, for example, from 4 to 7% per month. It's enough. It's average, it's 5-6%, it's average. And you have at least 50%, 40-50% per year annually. So, you understand it? You will have to spend a lot of time on self-analysis, parsing your self-trading journal, backtest, education. For that, you need to understand mechanics of profitable trading, and it is hard work that requires discipline, work ethic, and mental toughness. So, financial markets. Which financial markets we have? We have a forex. It's trading currencies pairs like a euro dollar, like a British pound, like a USD GPY, and it's crypto, Bitcoin, Ethereum, Solana, and a lot of other different cryptocurrencies. It's stocks and indexes like a Tesla, Google, Meta, and a lot of difference. In indexes, it's a S&P 500, it's a Nasdaq, it's a GER40, yes. Commodities, oil, metals, XAUUSD. It's a XAUUSD, it's a gold. And we can have a silver and something else, etc. Futures, we can have all really assets. It can be gold, cryptocurrency, indexes. So, understand it? Understand. What do we trade in our team? In our team, we trade indexes, cryptocurrencies, and currency. Personally, I trade Euro dollar. It's my favorite currency pair. I trade Bitcoin only and Solana, and I trade sometimes I can trade gold. So there are very quiet and highly volatility instruments that allows you work in both intraday and swing position and to swing trading. Forex is most liquid market in the world. Lately, trading volume is about from $6 to $7 trillion. It's unbelievable. It's absolutely insane. The most liquid pair is euro dollar. It's my favorite. All pro firms with which we actively works gives profitable conditions for working with these instruments. Market mechanics. Market mechanics is a set of processes that determine how and why prices moves. Simply put, is how buyers and sellers interact to ultimately form the current rate price of an asset. The price change when one side, buyers or sellers, is more active or stronger at a certain points in time. So, if the majority wants to buy and are willing to buy at even higher price, the price goes up, and reverse, price going down. So, main market participants. So it's so much important to understand it. We have a smart money. It's a minor players. It's like a while in cryptocurrency we call it's like a while it's person who has a really large capital. It's like a banks, funds, like institutional, professional traders. So retail traders, it's traders relative small amounts of money. It's like I am, it's like you, and a lot of different people. It's common people who don't a lot of money. Market makers and exchanges supply liquidity to the market. It's like majority stocks. It's like exchanges, others. It's like can be crypto miner stocks. It can be I don't know, and a lot of different stocks. You understand me? And exchanges. So supply and demand. Demand market participants wants to buy. The higher on demand, the higher the tendency for the price to rise. Supply. Market participants wants to sell. The higher the supply, the lower the tendency for the price to fall. Oh, not to fail, to fall. Sorry. When demands exceed supply, price going up. When supplies exceed demands, price going down. This is basic mechanics that underlies all financial markets from currencies and stocks to commodities and cryptocurrencies. Order block. An exchange's tag is the list of open position to buy and sell at a special price at any moment in this tag when there are many price levels at which order markets participants are ready to buy or sell. Types of orders. Limit orders, and we can have a market orders. Market orders, it's a current time we really do a trade and open a trade, but limit, we can really set a limit price, that price that we want to buy, we set it price, and sometimes it can use it can really start buying, and you can buy at the price that you really want to buy. So clusters of payment orders created levers. Market order directly move the price by absorbing limit orders. Liquidity. It's so important. When a market is said to be liquid, it means that he can handle large volume of transaction without significant price movements. Conversely, slow liquid markets, it's any high volume market order can change the price dramatically. High liquidity means that there are many participants ready to buy and sell, so in such a market the price usually moves more smoothly and technically. So, volatility. A trajectory of price over time It tells how much the price changed during the selected period. For example, if one asset had 10% growth during the day and the other 0.5%, it's obvious that the first asset is more volatility. So, you understand me? Smart money concept. It's like about all this course, it's about smart money concepts. Smart money, accumulation and distribution. It's only two things. Large players often accumulate a position where the price moves in a relatively narrow range. Accumulation. Distribution, when large players unload their position at a higher price after a rise. Liquidity and collecting stops. Large players need liquidity to accumulate large position. Retail traders collecting stops often occurs. Price short-term moves against the majority knocking them out of the market, and then continues to move in a anticipated Conclusion. The market moves because of the constant interaction between buyers and sellers. Its buyers are more active and willing to buy more and more experience, the price is going up. If sellers are willing to dump, their assets are at lower and lower prices, and price falls in the moment the price is pushed by market orders, which it limits orders in the stock. Understanding this basic is a foundation for further studying of price action, smart money concept, and other trading strategies. Chart analysis. What is price chart? A price chart is a visual representation of a change in the value of the financial instrument, stocks, currency pairs, commodities, etc. over time. Usually, the horizontal axis is the x-axis, shows the time, and the vertical axis, y-axis, shows the price. It's example, we can have example, something like here. So it's, for example, this x, this y, something like that. So Japanese candlesticks. The most popular chart types is Japanese candlesticks. They were invented in the 18th century by a rice trader at a rice exchange market in Japan. Japanese candlesticks are very popular due to the simplicity of information presentation and easy of reading. Price closed higher. That is opened, bullish candle. So this we have a bullish candle. We have a maximum, we have a minimum, we have opening, and we have a close. And it's like a bearish candle. We have a bullish candle and a bearish candle. It's the same, but it's reverse. We can mirror, and understand it. And it's examples. It's like bearish, it's like a bullish. It's like bearish, it's like a bearish, it's bullish. Bearish, bullish. Bearish, bullish. Okay. Time frames. We can have a 1 minute time frame, 3 minute, 5 minute, 1 hour, 4 hour, day, and week. The lower is a time frame is more noisy. Time frames for work are chosen based on the style of intraday, swing, minimum. Technical analysis. TA. Technical analysis is a way of predicting a price movement based on the past data. It studied regularity patterns and logic behind the price behavior on the chart. Unlike technical analysis, there is also fundamental analysis, the study of macroeconomic trends and news background in order to predict the price movement. Classic technical analysis included the use of various indicators, patterns such as head and shoulders, double bottom, flex, support and resistance levers. The main idea is a behavior psychology of the crowd forms repetitive patterns. Limitation of classical technical analysis. Indicators like there process price movement that have already occurred, so signals often appear when a bulk of the movement has already passed. Doesn't take liquidity concept into account. Classic technical analysis has little coverage of who is moving at the price right now, big players or retails. It's so much important, really. And where stop orders are concentrated. Patterns, templates. Since many patterns are known to everyone, it's head and shoulders, double top, and a lot of difference. Large market participants can manipulate these points at least provocate false breakdowns. Price action. Price action in analysis of price behavior, candlesticks, bars without of any minimal use of indicators. The focus in the chart is itself and the key levers, candlestick patterns, price reaction to news background. The main idea is the true market behavior is reflection in the price itself. The main idea is the true market behavior is reflected in the price movement itself, where the price turns, where they are quick spills or bursts, where a consolidation zone are formed. This is already enough to find a high profitable situation with high risk reward. A high error. We can have a 2 rather 3, 4. You understand it? You know it, the previous. Time and price. All we are interested in price actually analyzing is price and time. It's so much important. Price patterns and candlestick patterns do not excite the vacuum. They are directly related to the times of the trading session. Why this is important, we will discuss later. Trading money concept. Trading money concept is a way of analyzing the market through the lens of the action of big money, banks, funds, big institutional players, and institutional investors. It is assumed that they have enough capital to influence the price, and therefore it is important to read their footprints of the chart. The market moves where the large participant find liquidity, accumulation of stop losses, pending orders, panic selling, or crowd buying. And smart money concept teaching you to identify the area when the big players can enter or exit a position, talking liquidity and how it's reflection of the chart. Smart money is an attempt to explain what is behind the candlestick patterns, price patterns that we study from price action. So, price action is smart money. Price levers. Levers, its price, mark of average of limit orders accumulation, support the resistance levers are distinguished. Levers are areas of supply and demand. Price respects levers because traders' orders are placed there. Traders trade rebounds of breakdowns of levers. So we have examples. So this lever, and this is the same thing. So we have a break of structure, we have a retest, and then growing up in the upside. Okay. Lever by smart money price. Lever placed where market maker get liquidity, price going up, going out, respect levers, it's manipulated them. Enter does not come from a lever, but from lever manipulation, where the big player have already built up a position. Market structure the main type of price movement is trend and range. We have a trend, it's bullish or bearish, and we have a range, we have a consolidation. So it's three things that we can have in trading. It's all only three things we can have on the market. When the price is trading, it forms a structure long or short. Okay, it's an uptrend, it's bullish, it's a bearish, it's downtrend. So in this we have a higher high, higher low, higher high, higher low, higher high, higher low. In this we have a lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. So you understand it? It's a bullish trend, it's a bearish trend. We have a higher high, higher lows, and this lower low, lower high. Okay. And I so much want to really learn you and that you understand all of that. I really want that you all understand all of that information because it's so much important. If you want to become a really profitable, you must know it, please. So it's the same. It's like an example. Fractals or swing high, swing low. High and low patterns are formed by fractals with a candlestick patterns where three candles form a low or a high. So it's examples. So it's low, 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 low. So it's three candle. 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3. Okay, and this one. It's a low, it's high. It's low, high, low, high, low, high. Okay. Premium and discount area. The price range that helps you understand whether our price is an expensive zone, premium, or a cheap zone, discount. So we have only premium zone and we have only discount zone. So it's a premium zone, it's a discount zone. So we can really use it using Fibonacci. We can use it and understand, okay, which zone we can to buy, which zone we can to sell. It's good. It's so good. OT, optimal trade to enter. The price level inside the Fibonacci range. So, and we can really use it like this setup, you can use it. You can really modify in your Fibonacci. Please modify it, please, and use it before you really watch all this video. And you must practice, please. Really, don't only watch this video, please practice again. So it's the same. We have a long position. We have, I don't know how many error, but we have maybe, I don't know, it's maybe 7 error or 8 error, and I think it's absolutely insane. So we have a really good buy zone. So, and this zone called, how is called zone? It's all a discount zone. We buy in discount zone and sell a premium zone. Okay. Boss, break of structure. Boss is break of structure of the last higher low or higher or lower high with a subsequent fixing of the body above this fractal signal trend reversal, break, sweep, or inducement. Break from the fractal without subsequent fixing with the body of the candle with classic TA technical analysis in the called false breakout. So we have a higher high, higher low, higher high, higher lower low, lower high, and we have a boss. So we have a good boss, but we have a really, it's bad boss, it's fail, but this is true, we continue crushing. So, and this is a liquidity sweep, like here, and we have a boss of structure, break of structure, we have a downtrend. Yeah. Okay. Liquidity pools. The liquidity means the zone of accumulation of limited orders. Most often there are local or global highs or lows. Liquidity pools are all the same things. There are two types, buy-side liquidity and sell-side liquidity. Is BSL, is SSL. Liquidity is a magnet for price. Studying the chart, you will see that price goes from liquidity to liquidity, and gold trades are often gained from working with these pools. So price goes from liquidity to liquidity. Liquidity pools, strong liquidity pools. It's a previous higher low, it's a previous daily higher low, it's previous weekly higher low, it's previous monthly higher low. In a session high and low. So it's BSL, it's SSL. So BSL is what? It's what? BSL it's buy side liquidity, it's sell side liquidity. So here we have a buy side liquidity, it's sell side liquidity. It's the same. We have a inducement, we have a liquidity sweep. Okay, we have enter. Price goes from liquidity to liquidity, like I told you about that. In parallel, rebalance it in FLNs. So it's good. It's so much good. Okay, we have a position. Good. Good. We have really good really enterprise, because we have a really fulfill then beer candles, all fulfill bullish candles, and it's good enterprise to continue growing up. Working with market structure shift. It's a login. The shift is very similar to both, only it's defined on lower time frame set, working with the liquidity pools and order flow movement. So we have a boss of structure. Okay, it's good, but shift, it's like the first shift bar, the second is boss. So shift, what does it mean shift? It's K levels, strong low. So we downtrend, lower low, lower high, lower low, lower high. So we have a shift. We go, we retest and go and break of structure. It's like shift, this shift, this shift, this boss, but this fail boss. Quasimodo. The Quasimodo pattern is shown next. When price continue to move or reversal, throw sweep plus shift. So Quasimodo, what does it mean? It's higher high, higher low. So we have a liquidity sweep, something like this, and we have a shift. It's go, retest, go. Understand me? And we have a boss, something like here. Okay. So it's called, that is Quasimodo. When we have a liquidity sweep and we have a shift, liquidity sweep plus shift, it's called Quasimodo. And something like here, or here we can open a long position and really continue growing up. Or if we have something reversal, we can do the same but the different side. I mean, not long or short. Yeah, you understand me? Okay, and we have a price open and have a position, and it works. Yeah, it works, and this works, and we have a $4,000 profit. Okay, fair value gap. Fair is an area of the chart where price have moved too fast without normal counted volume. This creates a void of the chart when the market tends to close. If the market makes a strong impulse when does not test back into the area, it means that there is void left there. In the future, price often returns to the area to fill the imbalance to continue the move. So we have something go really bullish, really big pump, then we have a retest, and this retest is a FVG because it's a not fulfilled zone. We have go to this zone, and then we continue growing up. So it's like a retest, it's like a FVG, so it's fair value gap. So you must fulfill this gap, and only that price go to the up and continue this movement. So you understand it? I think yes. Continue. If you don't understand it, you can go to the 10 seconds later and listen it, or have something templates. For example, this. We can show a FVG, we can go to the FVG, we can long and have a continuation. And this we have a FVG, this have a FVG, and go to the moon. Okay, have a position, have a liquidity sweep, have a shift, have a, oh, it's not shift, and yeah, no, it's shift. Okay, I have a inversion FVG, inversion. In the imbalance that are overridden by the aggressive counter moves with candle bodies, consolidation often indexes a price reversal and can be used as an entry pattern similar to a shifter. So it's a IFVG, so we have a really good bearish market, so we have something small bullish candles. We have a really all fulfill this really bearish candle. Fulfill is IFVG called, and continuation growing up. So and we have a position, so something like here, something like here, yeah. It's a IFVG, and it's like a FVG too. Ah no, not it's like FVG, it's like FVG, IFVG. So and this one, we have a IFVG. It's so good trade, it's so good technical trade. I think it's so good technical trade. Order block. Order block is a zone of the chart when the price has a phase of consolidation. After with the strong impulse on the one side, in the context of smart money concept, it is considered that is in this zone that large market participant, banks or funds place significant volumes of order or limit orders, thus provoking further price movement. When the price returns to the order block, the interest of large players may appear there again. So we can wait it and go to the continuation trend. This price of really interesting to the banks, it's order block called. Okay, and we have its order block. So good. Open position, wait, have a order block, go, position completed. Something like this, it's inducement, it's strong low, and here we have an order block, it's go, good. We have an IFVG, we learn it. We have a order block, inducement, and we have a go to the moon. We wait it, order block, zone, we close position, we have a profit. So stop loss is like this lower low. So, but I can do this lower low, but I set this, but I can do this. So more or less. Okay. Sell to buy, buy to sell. Sell to buy to sell. In the context of smart money described short-term manipulation of the market is opposite direction before the main movement. Sell to buy. The market is squeezed. Pending orders concentrated to the bottom. Price when quickly reversal upwards continue the bullish movement. Similar put, sell to buy, cheaper later. Buy to sell, the market is shampoo pursued upward to gather liquidity above the previous highs. Price when a reversal the downward and goes into a bearish momentum. In the other world, buy to sell higher later. The movement is often ruled by bigger player, smart money, who do such manipulation get a best entry for the main position, buy or sell, using knowledge out, stop orders, and crowd emotions. So we have a release this zone. We have this zone. We have a position from this zone here. Top-down analysis. Top-down analysis. Method of the market analysis is which trading consistently evaluates the price dynamics from large timeframes to small timeframes in order of words. Start with daily, weekly to understand the global trends and clearly support the resistance zones. Then moves to the medium timeframes, 4 and 1 hour, clarifying more locating levers and potential targets for traders. And finally looks the lower time frames, 15 minutes, 5 minutes, and I do it, all of that I say you, to find a special entry points, price stop, losses, and manage the position. This top-down approach helps not to get lost in the noises of the market bullish overall picture and increases the probability of opening trades in the right direction of the global trends. Market fractal. The same price patterns and patterns repeated to themselves of different time frames. The small time frames is similar to large time frames. The same principles of trends, correction, reversal patterns are found on a minute pattern as well as on a daily or weekly chart. Only the scale is different. Self-similarity. If you zoom in on a small part of the chart and compare it with a more global movement, you can see the similar strategies. For example, soft-off movement, if an uptrend can be observed on both small and large tips. Fractal application. A trader who has mastered one models of the price behavior can often apply it on a different time inversal. The top-down analysis approach takes fractals into account. We look for a general patterns on a higher time frames and work them out in details on a lower time frames. Okay, we know it, we find it. We have a structure. For our shift, we have a order block, we have a inducement, we have this zone, this level. We analyze all of that, we open position, we take a profit, we have a take profit. Order flow. Order flow is an order flow as it moves the price from point A to point B. By correctly defining it as the order flow, you can find a good continuation of the movement to the main price delivery target. On the chart the chart, the order flow leaves trace in the form of a test of Marist, POI, Fabergé order block before continuing the main movement. Sweep or Pickweed, KL, pull, sweep before continuation of the main move. So we have a POI, we have a position, go, complete. It's like here, like this, like this. It's POI is point of interest, I FABG order block. So in this we have a position. It's a POI. Is this a POI? This a POI? This a POI? Range. Consolidation. Range or sideways is a period when the price fractals fluctuates in a relatively narrow price range without a pronounced uptrend or downtrend. Essentially, the market is stuck between pools of liquidity and the price moves up and down within this corridor. So we have a corridor set up for range. It is not recommended to gain position inside a sideways trend, as there is a high profitable or of getting to stop loss due to the uncertainty of movement factor. The best strategy for dealing with a range is to wait on the amount of liquidity pools to be withdrawn and returns to the range with the formation of the entry patterns as an open position and on the opposite liquidity pools. It's the best way, I think. So we waited, and have a result. Good. So I can show you again. We have a range, we have a and we have a take profit. We must wait for this. It's so good. I'm the pattern. Accumulation, manipulation, distribution. So this model is often encouraged in the market, and by understanding if you can find good points to the entry position, accumulation in the market enters the phase of consolidation, manipulation in the price shortly goes below the boundaries of range to collect liquidity, and distribution of the short-term manipulation of liquidity gathering as the price moves into the main movement. On this moment, is a big companies will fix their position. So we have a accommodation, this is like a consolidation, this is like a range. So we have a manipulation, go to the different side, it's uptrend or downtrend, it's boom boom, it's go up or down, yeah, it's a manipulation, you just like things other. Any distribution is the main, it's the main really trend, it's the main really movement in the market. So it's so good, we can open this position when start distribution and make a trade profit and set our stop loss like here and position open this stop loss like here and take profit like here. So in this good trade, I think, so we must open position only this distribution before distribution. So in this we understand consolidation, range, manipulation, and distribution. In the main really movement, we can open position to continuation. Of course, to continuation, but not something different, not reverse. No. So in this one, trading sessions. Volatility in trading volumes vary depending on the time of day. There are several case trading sessions in the market. In each of them, we can open specials. Case session, Asia. It's a Frankfurt, and it's a what else? It's a Frankfurt. It's a Asia. I don't know what is this. Okay, it's London and New York. Asia, it's Sydney and Tokyo. Oh, I remember. Asia, it's Sydney and Tokyo. But I all time using Asia. I don't using Sydney and Tokyo. No. I using Asia, and all traders are using Asia. It's called Asia. Trading sessions. Studying the patterns of the price behavior of the selected trading assets should be necessary to done the context of time of day and sessions. Certain setup have a much higher chance of working at 9 a.m. after 7 a.m. simply before it of the way session usually change. Okay, we have Asia, we have Frankfurt, we have London and New York. It's the same. Trading session, American indexes, Nasdaq 100, S&P 500, Dow Jones have their own specific. So this index, this American index has their own specific. The greatest volatility occurs in the New York session at 9:30 in New York as the opening of the New York Stock Exchange, and the session is delivered in the free part AM, lunchtime, PM. And when closing market assets, you can need to study which session are the most traded and when is the most favorable time to open position. The most good time to open a position, and you must understand which session is the most volatility that you can to trade. And the most volatility it's a New York session. It's London, yes, and it's New York session. And you must trade only, for example, in New York session. All time you must trade. So it's a New York session, New York. So it's the most volatility New York session, yeah. Okay, news background. The relay of news of macroeconomic indicators rarely affects on the volatility in the market of such resource as Forex Factory on investments.com. You can find an economic calendar which you can use it. You can follow in the news during the day, and you can understand which time you can trade, which time you can't trade. So, and if you trade prop firms, some prop firms allow trading in news during the news, but some prop firms can't allow to trade during the news. It's when US President Donald Trump something speech and talking about something about cryptocurrency, buy Bitcoin, please. Something like that, and maybe other stuff. Okay, we have a ICP, it's a news. And we have a Trump stop tariffs. Okay, it's so joke because sometimes Trump from morning Trumps say something, from dinner Trump say something else. And it's gonna be something really different. Oh, and it's so joke that really Trump said, I don't know really what going on is this fucking world. Really, I don't know what is going on. It's crypto reserve news. Oh, it's so good because crypto pump at the time. I remember it. I really remember it. But Donald Trump really approved crypto reserve. It was absolutely insane, and all crypto really pump and grow up. And oh, it's so big money I can make, but I didn't do it. Risk management is the most important thing. Risk management, fundamental. Without any understanding of risk management and the mathematics expectation behind profitable trading, studying chart analyzing tools making no sense. Really, making no sense without all of that. A good analyzing allows you to find a good situation and a high profitable of a positive outcome for the traders. So it's mean take profit. It's mean money, a lot of money. Following this risk management gives the opportunity to earn money. Free variable, win rate, average error, risk per trade. It's so much important. And all time you must count it, which win rate you have, which error risk reward you have, and which risk per one trade you have. You all time must control it all time, please, because it's so much important. Really, risk management, it's the most important. It's your psychology, it's risk management in your strategy. It's the most important three things in your trading. Please do it. Calculate your win rate. Its win rate is percent of win trades, average risk to reward ratio. Risk per trade is percent of risk for one trade. It's, for example, 1%. Yeah. So model 1, high win rate, low error. Win rate 30%. It's so good win rate. Average error 1.7. It's not good. Risk per one trade is 1%. So in average GSM for 30 trades, you can have average plus 14 profits, 14% of profits. So it's 6 of 10 trades will be winning. Model 2 is medium win rate, medium error. Its win rate 40%. It's plus minus good. Average 3 error. Oh, it's good. It's good. I use it because I use it personally. I use it model 2, and for me it's so good. Or you can use it model 1. If you are a beginner, you can use model 1, and then you can use it model 2, for example. But model 3 for me it's so bad, and if you are a beginner, you're maybe more emotional and it doesn't work for you. So you must use only model 1 or model 2. So in model 3 it's low win rate, a high error. Win rate 24%, average error 6, risk reward per trade 1%. You can have plus 15% per 30 trades. It's only 2-3 out of 10 trades only. So win rate 20, it's not profitable, no problem, no, it's only 5. 30, it's you profitable, it's 3 error, 4 and 5. 40% it's 2 error, and you profitable. 50% you profitable, 2 error, and 30% you 1-to-1 error, you can be profitable. It's 50% and 1-to-1 error, and you can be profitable if you have a really good win rate, or something 40%, for example. You must have at least 2 error to become a profitable, or more good, it's a 3 error. So you understand, 2 free error, and I have a 40%, and I have an all-time 2 free error, and I am profitable. So this trade, all 3 models works. However, it's important to realize what each of them have different degrees of psychology alone. Many traders began to lose self-control when they get into a series of losing trades, and I know it, and I said it later because I know it. So model 3 is definitely not suitable for them. So for beginners, it's model 3, it's not suitable for you if you are a beginner. Everyone should find their own style that suits their psychotype. The main things in trading, it's the most important thing. It's the most important thing because it's a conclusion all that we study in this trading course. It's the most important thing. Please go. You can be your own biggest enemy to trading. Not the market maker, not a market, not a big player, not a something else, not a bank, not a funds, not a something else, not a, I don't know, institution and individual investors. No, not a, I don't know, something like that. The big enemy, it's you. It's you. Most people don't succeed here because they couldn't find the reason for failure inside and correct the repeatable mistake. So your mistake is repeatable. Repeat mistake. Don't repeat mistake, please. Don't repeat mistake. And they couldn't find the reason for failure inside. So people have a problem with psychology, and people have a problem with really repeatable mistakes. So you can fix it and you can have a result in trading. Don't make a repeatable mistakes and don't have an emotion, please. Work it with your status. Trading is about discipline if following your system. And I told you about that the first time in this video I told you about that. If the person is an impulse and an overlay emotion in his life, it will definitely show itself in trading. So if you're so emotional in life, you will be so emotional in trading. Sport, meditation, keeping a diary, digital detox, proper nutrients, avoiding bad habits, all these are common practice in the lives of successful traders. So you must do it. Sport, meditation, reading books, reading Bible every day, praying God every day, have something disciplined work every day, something proper nutrients, avoiding bad habits, because all bad habits can really give you bad results in trading. Sustainable self-analysis. Reflection is a independent, indispensable process of the developing in trading. Oh, it's so hard word for me. You must analyze every step to take, every decision you make, every trade, every mistake. Please analyze all your trade, all your mistake, and all your decision. Please, if you find a mistake that you make all the time, the focus on removing it, and remove it. Over trading, leverage trading, unable to accept losses or capitals, all these things will kill traders' deposit and their belief that it's possible to make money in this sphere. So, it's really important to understand. Sooner or later, everyone will face his demons. The one who can admit his weaknesses to himself and correct them will win. So it's so much important. You don't must have something demons, enemies, and something like that. And in life and in trading too, you must understand it. And if you lose all your capital, it's not a problem. And you must believe that you can achieve something. Don't give up, please. Distance mindset. You won't get pumped in 3 months. You have spent years of life following the diet, exercise, and recovering ligaments to build a cool physique. You won't learn a new high-paying profession in 3 months. Many people take a minimum of 6-12 months to get started in entry-level position. To become a doctor, you need to spend 7 years of schooling and then a lot of internship and apprenticeship. Do you want to make millions here in a month? You really want to make millions in a month? Bro, it doesn't work. Please. If you want to become a doctor, you must spend 7 years. And my grandpa really is a doctor, and he spent more than 7 years in the university. And then we have a practice, and we have something in internships and other something like that. So you understand it's more and it's a 1 year. So 6 years in university, in 1 year it's internship. So it's 7 years. It's so a lot of time. It's so much a lot of time. So you must understand it. Result, it's kind of a lot of time to become a profitable, to become a really successful. Expectation mindset. Trading works a distance before a properly formed trading system has a possible expectation matrix over the large sum of trades. One trade does not define you as a trader. It's not a distance that defines you. Once the distances are above profitable and losing trades, and you never know for sure the income of each of them. That is why this important thing to know is probabilities. Anything can happen in the market, and you control is the risk and entry point, the exit point. Realize this, and you will find it much easier to follow the chart. What further and what the next you must to do? You understand all this practice, or you understand all this theory, and then you must practice. So what you can do? Backtest, please analyze all these things that I gave you, you must really practice. You must understand it. You must do it. Demo trading, small prop accounts. You can buy a small prop accounts like a funded pips, funded next, FTMO, the 5% years, yeah, EA, for example, prop firm, EA market, it's maybe called. So, and you can do it, practice, practice, and practice. That you must do, please. Thank you for watching. Subscribe in our Telegram channel and YouTube channel. I thank you for watching. I really appreciate you that you watch my full-time trading course. I really appreciate you. You can press like, you can subscribe, and go to the Telegram below in the video. Link in the description. You can go to the Telegram. It's about new insights. It's about trading. It's about cryptocurrency. You can find a lot of interesting things, a lot of interesting insights, and really a lot of interesting opportunities. You can have to make a lot of money, maybe, I don't know. It's dependent all in your, it depends on your, so you can do this decision. You can go to my Telegram channel, so link in the description. See you in the next video. I really thank you for watching. Bye bye.